Hi, everyone. Thanks for tuning in to NAB's Business View 2022 Outlook. I'm Andrew Irvine, Group Executive of Business and Private Banking for NAB. And joining me today is Alan Oster, our Chief Economist. Alan, here we are in December 2021, coming out of 4 months of, a little bit of difficult lockdowns on the Eastern Seaboard. But as I'm out and about in Sydney and in Melbourne, I can see incredible optimism. CBDs are coming back. The business owners that I'm talking to are really optimistic about the trading season coming up in Christmas and into 2022. There's a real vibe around the place. How are we feeling about where the economy is sitting right now? And tell us about your views for what's coming in 2022.
Well, what's interesting is, yes, it's been very tough. We just had the GDP numbers for the third quarter. Okay, it was the third worst quarter of all time, but it was much less than what people expect it was going to be because, to a large extent, the non-East Coast of Australia was actually doing really well. And what we've seen in our own internal data, basically since about mid-October, is a really big increase in consumer spending. Hospitality is coming back. Yep. Retail's really strong. We just released some data that said Black Friday was a boomer. Everybody went out, particularly durable goods.
Yeah.
And so I think the economy's coming back really strongly. And so if you're thinking about where are we now, I think the GDP numbers in the fourth quarter are probably going to be at least as strong as the fall in the September quarter. So if you like, we're net neutral.
Right.
And so all the losses of the lockdowns have basically been caught up by the end of this year. And that is brilliant.
So Alan, 2022, tell me how you're thinking about the year to come.
Well, we still think that there'll be growth somewhere around about 4% during the course of the year. So that's obviously much stronger than what potential is, which is more like around two and a bit. And so we're really essentially seeing the economy recovering further ground that it's sort of lost relative potential. We're making an assumption, one, that the Omicron virus sort of doesn't upset us all again. And secondly, that, broadly, by the middle of the year, you'll start to see more people coming into the country. The state borders are down. And I think in that sort of environment, you see more consumption. We really do expect, on the back of what we've seen in the last month or so, that the March quarter numbers will be strong and so will be June, and then will come down. It means that by about the end of the year, unemployment could be approaching 4. But I think we've got forecasts around 4.2. So it's really saying the economy is up and running. I think there'll be very strong demand for business investment. And as consumption, people will still increasingly want to start going to gyms and haircuts and all that sort of thing. That will continue. So consumption will drive the economy forward.
That's great. And, I'm sure our listeners want to know about your view on house prices in 22. What's the house view on house prices?
Well, the house view is basically that house prices, having gone up, say, 24% this year, probably go up another 5% next year. I'm a little bit more worried about 2023, but we can talk about that later. But, you do need to think about that at some stage when interest rates start going up, maybe in 23, that you will see house prices come back a bit. But context is, we're just talking about a 30% increase in house prices in this year and next year. The year after, if they go backwards, say 10, you're still well and truly up.
Right. So when I speak to business owners right now, there are two things I generally hear. One is access to labor is a tough problem and we just can't get enough people. And the second one is we're still feeling the effects of COVID in terms of the supply chain disruptions. Talk to me about how you see those things playing out.
Well, there's certainly true that it is, particularly in some sectors, it's very difficult to get labour. So you talk to people in agriculture because there's no backpackers to pick the crops. You talk to construction, they can't get wood, they can't get steel for the housing frames, etc. Some areas like wholesale have trouble as well. More generally, it's not so obvious. So if you like, it's more industry specific, and also in some industries, particular trades like technology, you can't get people there. So we are seeing some problems in relation to ability to get labour. Supply chain problems essentially have also meant that therefore they put up the price to some extent. Again, the core inflation numbers were higher than everybody expected. There were some technical issues there, but broadly, what the Reserve Bank is saying, by the middle of next year, some of these things might have gone through. We are seeing in some of our data maybe the increases in what we call purchase costs are starting to come back a little bit, but they're still very elevated. So when you look at that sort of story, it's nowhere near as what you're seeing overseas. So if you think about what's happening to wages in New Zealand or the US, UK, Canada, you see very strong increases in wages. You see inflation rates in the USA 4.75, and they're targeting 2.
Right.
Whereas in Australia, inflation, they're targeting 2 to 3, and for the first time for 5 years, we've hit 2.1. So it's slightly different story, and you see things like overseas energy costs, particularly electricity prices, through the roof. In Australia, electricity prices are actually falling, which is really unusual. But generally what you're seeing, yes, wages are difficult in particular sectors. General inflation is up a little bit more than what we thought, but hopefully by the middle of next year, some of those pressures will start to come back down. And then you really need the economy to do really well and push generalised wages up to above 3% before the Reserve Bank will start even thinking about increasing rates. And the other thing people need to remember is the Reserve Bank has in the past been what they call an inflation targeting central bank. In other words, they'd say, right, we're thinking inflation next year is going to be 3, so we're going to start increasing rates this year. Because they haven't even got to the bottom of the target for 5 years, they're about to say, right, well, we're going to see it. Inflation, the runs have got to be on the board.
Before they move. Right.
And so that sort of says to us, and I know everybody's interested about when do you think inflation's going to drag the RBA to start increasing rates? We still think it's 23, not 22. Financial markets around the world are starting to say it's definitely 22, and the Fed said the same thing a couple of weeks ago. And we do have 2, potentially 3 rate rises in the Federal Reserve next year, but we're still saying it is going to take a bit longer in Australia. But when Australia goes, I think they'll go quite aggressively, just like we've seen recently in New Zealand. And so that then feeds back into the issue about house prices maybe being a little bit softer in 23.
All right. So Australia just a little bit behind the rest of the world on inflation and therefore interest rate rises.
Yeah, and we came from a position in terms of unemployment much higher than what the other countries had.
Tell me about, if we move a little bit for a moment outside of Australia to the global economy and how you think the global economy will fare in 22.
Well, again, subject to the virus. Right. And our assumption is it's not going to be that bad. Hopefully we'll find out in a few weeks, are the vaccines going to work or not, or can you get a new booster that fixes it up? I think they'll probably will. We think that 22 or 21 has been a year of recovery, and 22 we think it will also be quite strong. So this year growth looks something more like 5%, maybe 5 3/4, a bit higher. Next year more like 4.5%, and the year after that what we're seeing is back to trend, which is around 3%, but differences across different countries. The US at present is very strong, and we're talking about December quarter in the US at 5% growth rates. And that's also feeding into the story about elevated growth, elevated inflation, and starting to increase rates. If we're looking at Europe, it's been a bit of a surprise in the sense that the economies, particularly in Europe and the UK, have been very strong, but we've all assumed that whilst they haven't had the lockdowns that Australia had, they have started to have lockdowns, and we thought that would be showing up in activity. It hasn't yet. And so what we're sort of saying is pretty strong growth in Europe as well. They're probably behind. They're more like Australia in terms of when might they increase rates. The UK, I think, is thinking very seriously, and they could well go by December. And so they're closer to the New Zealand example, where things have been really strong. House prices, you think house prices are strong in Australia, go over to Kiwis.
Yeah.
And so they've already started, and, you know, New Zealand will probably not be as strong, but they've certainly come back with a huge kick. So I think generally the story offshore is they're really good, they're recovering, they're going to continue for a while and then back down to trend. But a world of increasing rates globally is probably coming next year.
Well, that all sounds super positive. 22 also, we shouldn't forget, is an election year. So where's your thinking in terms of government stance on fiscal policy?
Well, Andrew, I've been in Federal Treasury for 15 years and this job nearly 30. I have never seen an election where they don't spend money.
Right.
So that's what's going to happen. In terms of when the budget turns up, we've got the tax cuts that have been basically announced, and Labor said that will happen, and that's really important in terms of simplifying the system. We've also got, I think we're going to see a lot of talk about global warming and new targets. So the Labor Party's already put a target out there for 2030. And then beyond that, I think there'll be lots of support for particular parts of the economy. Which bits? I don't know. There'll be political things in there, but I would hope to see more on helping business in terms of support, manufacturing, things that we do well. I think there'll be talk about how we can get around potential difficulties with China. But generally, I would expect to see that they will continue to spend. It will be big positives. Our forecasts sort of imply the public sector demand will be growing at 4% or more. And so the public sector will be going faster than the private, or as fast as the private sector. And so it will add to growth momentum.
So we've talked about the strength of consumer spending in Australia, but I think it's pretty clear that this is going to be a business-led recovery, and we're going to see businesses investing in plant and machinery, I think, bringing supply chains onshore wherever possible to mitigate some of the disruption. And hopefully, as more labour comes into Australia, that will also drive economic activity. We're here to back that growth and that momentum. And so really excited about the opportunities that we're seeing for business owners to deploy capital. And we're excited about the opportunities that we have to support that. Well, with that, Alan, thank you for your comments and contributions to the discussion today. Really appreciated your insights. To our listeners, thank you so much for joining the conversation. Wishing everybody a very Merry Christmas and a happy festive season.